you very much, Shireen. It's a real pleasure to be supporting the DIFC FinTech Hive again on this set of sessions. And for everybody who's joining this afternoon or morning or evening, depending on different time zones, it's a real pleasure to be with you today to present on venture capital financings. My name is James Coleman. I'm a partner in our regional corporate practice, and a very significant part of what I do is helping early stage companies, high growth companies on attracting capital, and also investors participating in startups. Now, I'm very, very pleased to be joined today by two great colleagues, Kim Farah and Takesha Keylock. Kim, Takesha, do you want to just talk a little bit about yourself as well?
Sure. So I am a senior associate in the corporate practice. I am based in the UK. I was based in Singapore for in the Simmons office in Singapore for 5 years before relocating back to the UK at the beginning of January last year. I do general M&A and investment work, but have historically done a lot of venture capital work, mainly working for investors, but also advising companies on their fundraising from pre-seed, seed, Series A, all the way through to Series C. So that's me. I'll hand over to Takesha.
Hi everyone, I am an associate based in the Dubai corporate team. So similarly to Kim, I have experience in sort of broader M&A as well as private equity and venture capital. I've worked both in the UK and in the region on those types of mandates, acting for both investors and founders. And particularly recently in the region, we've seen a big uptick in sort of Series A and pre-seed funding rounds. So that's been keeping us very busy.
Thank you both. Now to this year's cohort on the call, real congratulations. We've been legal sponsors, as Shireen's mentioned, to the Hive now for a good number of years. And what is really impressive to us is actually just how the quality of the applicants just increases year on year. So that bar's getting higher. And really interesting now, what we're seeing is that a lot of the historic participants are now really doing some great things in the region and wider internationally. So all credit to you guys for being admitted to this year's cohort. Now, why are Kim, Takesha, and I going to be presenting to you today? What have we actually got to say? Well, as we've flagged, we very much focus on the VC sector and work very closely as well with our colleagues in the commercial side who support technology companies on what we call the plumbing aspects, the mechanics of your businesses. And what we particularly focus on in the region is fintech, where we are regarded as one of the leading firms. So we really know your businesses, both from an investments perspective and from sort of the day-to-day business. Now, a little bit just on the housekeeping front first. I think Kim, Takesha, and I would welcome people asking questions as you go along. There's a chat box that is available. I think there's a chat which everybody can see, but one where you can also pose questions to us. So put it in there, and Takesha will then pause us during mid-flow. Equally, if you want to raise questions towards the end, we can do that. Now, as regards today's topic, quite clearly venture capital financing, we just really wanted to talk about the basics. It's really quite a big area, and so what we're not going to be doing is really a deep dive into all the different approaches and terms. That's something we can do later on a one-on-one basis or in a different session. Just get in touch with the Hive if you would like that. But I think coming out of this session, we just want you to have a bit more of a familiarity around the types of conversation, the types of structure, the types of language and jargon that you're going to be faced with on a VC financing side. So that is the introduction. Kicking off now, we just wanted to look a little bit about why do you need financing, when, and who do you get financing from? I'm not going to channel Heath Ledger. He's a far better actor than I will ever in this life or many other lives be. But the long and the short of it is that as a startup, you are going to be burning through cash, a lot of it, and quickly. But it is quite clear that without startup financing, the vast majority of startups are quite simply going to die. And what we're also seeing as well is that the amount of money that's needed to take startups to a level where they're profitable is actually usually well beyond the ability of any founders or their friends and family to actually self-finance. You need to build core teams, you've got to launch core products, you're scaling the business model, both as regards your customers and your geographies as well. And that just takes typically money. But let me just pause there. Can anybody guess the connection between these entities?
Feel free to drop your answers in the Q&A if anybody wants to have a go.
Anything coming through, Tikisha?
No,
okay.
Everyone's being too shy.
Well, in short, all of these bootstrapped. They didn't go out to the market and get venture capital financing. And so, this just goes to show that you can actually create fantastic startups without raising funds. So, for example, the founder of GoPro, Nick Woodman, did his original funding by basically selling bead and shell belts out of his VW camper van out in California. It took him 10 years to get there, but he got to his IPO with a $3 billion valuation in the end. There's some benefits as well to bootstrapping. If you've got no money, then that basically means that you as a startup are going to have to look for those efficiencies because money is going to be really at a premium, and that really creates great businesses. That said, it's quite clear that if you've got cash, that allows you to live, to grow. It creates a war chest, gives you a competitive advantage compared to some of your competitors. You can hire key staff, you can go on PR and marketing roadshows, and therefore it sort of goes without saying that most startups pretty early on in their stage will want to be raising money, and not just from friends and family. The really good news is that the markets now for investment in technology are really good. So there is a lot of money out there that's willing to make investments in early stage companies. But that money tends to follow the right startups. Those are the right business model. The bad news on all of this, and you will have heard this many times before, is that fundraising is brutal. So the number of times that Kim, Tikisha, and I have conversations with the founders, and they just go, this is so draining, because actually getting the right investors coming in is really quite challenging. Let me just pause there. Kim, do you want to just talk us through about when you want to fundraise?
Yeah, thank you, James. So when you decide it's time to start raising funding, this will very much depend on where your company is at, how quickly you want to grow, but also how much of your company you are prepared to give away. On the flip side, you don't want to be turning down investment when an investor is ready to invest. Sorry, investors will generally look at a new company quite closely, and they will want to hear that you have a great story to tell, that you have a product which sells, and that you have a track record. Now, a track record is very difficult when you've set up a new company, but the investors will want to see that you have done your research and you have a product that's ready to go to market and will attract attention. For some founders, it will be enough to have the story and the reputation, but for others, you will need to demonstrate that you have a sufficient customer base to build or to continue to build the company. So what should you do before you take your product to investors? You'll need to think about where your product is going and what the opportunities are for your product in the market. You'll need to demonstrate that once you have the money from the investor, that you'll be able to, in a relatively short space of time, develop that product, get it to market, and get that money coming back in. How quickly is quick? Well, we'd say a rate of 10% a week for several weeks, a month is an impressive rate for a startup. So I'm going to hand over to Takesha now, who's going to give you a bit of information about who the investors are at this early stage.
Whoops, I left myself on mute. Apologies. Thank you, Kim. So as you can see from the slide, and I'm sure you are all aware, there are various sources of financing available for startups. And the type of financing that you seek or that is suitable will very much depend on a range of factors, from the stage of the business to the complexity of the product, any sort of OPEX or CAPEX requirements. But we're going to just give an overview of the various sources, and as we move from left to right across the slides, you'll typically see the sort of level of sophistication or level of involvement, if you like, increasing. So the first and probably the most obvious, which I don't think we've taken off there, but James touched on the bootstrapping of businesses. So I'm sure many of you will be familiar with essentially growing your businesses right at the inception of an idea, without outside capital, using either your personal savings or personal debt, which is obviously a good way to get the business off the ground at inception. But of course, with that comes sort of a lot of time in the investment. You need to have a certain degree of personal risk tolerance and obviously confidence in your business. James mentioned, there are a number of highly successful businesses that were heavily bootstrapped and relied on that method of funding. So it's not something to be overlooked, but obviously depends on your personal circumstances. And then moving on from that, quite closely to sort of bootstrapping is basically seeking out small investments from friends and family. Usually we would see this done via, hopefully we would expect to see it done in a formal way and documented correctly, because one of the challenges with this is at the very early stage of an entity, when things are not all in order, the house is not as it should be, let's say, it may be common to seek out financing on a more informal basis, and so the kind of key message here around using friends and family to finance your venture is just making sure that, first of all, noting that personal relationships are going to be sort of potentially strained and at risk, but just to make sure that you maintain those professional boundaries with anybody that is providing you with that early investment. So moving on, I'm kind of jumping around the slide slightly to incubators. So obviously all of you are familiar with the function of an incubator. And here we're really looking at financing, moving away just from the pure financing kind of benefit in a monetary sense that you get when you're involving outside investment in your venture. And some of the real value with incubators, and as we move towards the more sophisticated end of the financing structures, comes from sort of the mentorship and the startup support that can be offered. Now, in return for that, and this very much depends on the structure of the incubator and where it is, we would typically expect to see a very small investment being taken in the business, so something from around 5 to 10%. But again, this will vary, and also the structure of incubators' investments into startups can vary. So we'll touch later on the use of different types of notes and instruments. We might typically see the use of sort of safe notes, which we'll discuss later, and convertible notes at this stage. One of the more innovative sources of financing is crowdfunding. This is becoming more popular recently, and so as people are becoming essentially more savvy and looking for innovative ways to fundraise, there have been a growing number of new sort of crowdfunding vehicles. So you may be familiar with AngelList, Kickstarter, the likes of WeFunder, etc. And this can be a really good source of funding for an initial launch of a product or a sort of isolated or discrete part of the business, funding part of the business. So for example, if there's a specific sales campaign that's needed, etc. In very limited circumstances, we are aware of founders using these sites as sort of dominant fundraising sources, but I think it's fair to say the primary use for this kind of function is as sort of a gap filler. And what it does show is that the availability of different sources of funding is rapidly changing, and the sort of ecosystem and the manner in which financing is raised is developing. And so it presents an interesting proposition for you guys as founders and when you're thinking about your initial options. Moving on towards the sort of mid-market sort of pool of investment, we've got angel investors. So these are typically private investors who are investing for their own personal interest, or you know, they may have specific sectors that they are particularly focused on, but they typically invest at sort of the seed and startup stages of the company. They may invest more and increase the size of their investments depending on sort of what the nature of the business is. Although some angel investors are quite rigorous and do have more sort of, you know, solidified investment methods, these are still typically not as structured as we move towards the other end of the financing options. Here again, also with angel investors and similarly with super angels that I'll move on to now, you'll get the benefit usually of sort of hands-on, you know, support with the business. So just to touch very quickly on super angels. So this is the term that's used, you'll be familiar with it, to describe investors who are sort of a halfway house between angel investors and then a VC fund. And this is where you'll see the investor being more focused on an aligned sort of portfolio of existing investments. You might also see a group of super angels pool their resources together to form a fund. But typically these will be used at the seed round, and again at sort of or pre-seed round at the early stages of the business. Moving on to venture capital. So venture capital, we're coming towards the more formal structures of financing. So this is essentially a pool of funds that is distributed on behalf of specific stakeholders of said fund. So there are lots of international funds that you'll be familiar with, the likes of Quake Capital, Insight Venture Partners, Goldman Sachs, etc. And the primary difference between the funds is that, and angels, is that the fund are sort of professional investors. They have fiduciary duties owed to their stakeholders. And so they're going to be much more focused on the detail. You're going to see much more time involved, more meetings, a more rigorous due diligence process. VCs obviously see lots of portfolio companies and invest in very few. So the key with dealings with VCs is to make sure that, you know, the business stands out. We're going to touch on this in more detail as the presentation moves on, but we typically see here VCs moving from sort of safe and convertible note investments towards, you know, the priced equity rounds in terms of the way that financing is structured. Just lastly, on the equity side of financing, there may also be sort of strategic investors. So where there's a synergy between an existing business and your company, you might see a strategic larger business looking to basically bolt on your business to its existing operations. This can also involve the use of licensing agreements or marketing or distribution agreements. And just lastly, to talk about venture debt. So contrary to all of the other types of financing methods that I've run through, there is obviously also the prospect of using debt, so via, for example, commercial banks. And depending on what the financing needs are, this can look a whole range of ways, typically involving capital loans, could be equipment financing, for example, and those loans are typically shorter term than an equity investment, so usually a 1 to 2 year term. They'll be more specifically delineated in terms of their purposes, and they will usually include quite onerous covenants and legal terms around, for example, the metrics that are used and the specifics of the application of the loan. So that's just a very sort of broad brush over the types of financing. As you can see, there are lots of options available depending on where you are in your development process. And now we are going to take a closer, more focused look at the venture capital structure.
Thanks for that, Tikisha. Just a very quick word on the strategics. I think there's a bit of a trend that's going on at the moment where a lot of corporates are setting up venture arms. And these can take many different sizes and shapes. Some of them will be, classic venture, so they won't really be investing with a half an eye towards what their parent organization is doing. But increasingly, they are looking for those synergies. And when you are having discussions with them, you do need to have quite careful consideration about how you structure the terms. There's a whole different session on that. Right, so venture capital funds. At some stage, when you're getting down the funding sort of life cycle, you will work with venture capital funds. So you will need to understand what is going to be driving them. Now, with slight apologies here because there's going to be some fund terminology, but I just want to describe a little bit about what a VC house or a VC fund looks like. So you've got there like the Sequoias or a Becco Capital or one of the really big ones, Tiger Global. Now, in short, these use limited partnership structures. And a limited partnership structure is effectively a structure which comprises one or more general partners. And so you'll often hear the phrase a GP, and that's the venture capital firm, so Becco Capital. And then they will be going out to various investors, which are called LPs, limited partners. These can be high net worth individuals, family offices, sovereign wealth, pension funds, and the like. And together they will then effectively form the fund vehicle, which then goes out and deploys the funds received. So that's what a limited partnership structure looks like. But how does VC make money? You will typically what they'll do is they will put cash into the fund themselves. So the venture capital firm will do a small investment so they've got some skin in the game. And this is important to know because when the VC houses are diligencing your businesses and making a decision on whether or not to invest, it's not just the LP's cash that they are looking to protect, it's their own money as well. So they're really going to be kicking the tires. What we typically see is the amount of cash they're going to be putting in is going to be about 1 to 3% of the total fund size. They're then going to be taking a management fee and something called carried interest. The management fee is effectively an annual fee paid maybe quarterly of typically 2%, though in the venture capital arena, that might be a little bit higher. So we're seeing sort of 2.5, sometimes 3, but it'd be a bit unusual. And the 20% is effectively a 20% share in the profits generated by the fund after the investors, so those LPs, have got their cash back, plus a preferred return. So that's effectively what they're getting. There's the return of principal and the preferred return. When do VCs make money? Well, they make a little bit of money on the management fee, but they all make it on the exit. So that is what they're going to be focused on, which basically means that these are not going to be long-term or very long-term investors. They will always be investing on the basis of an investment horizon, which is probably going to be between 5 and 7 years. So when you're going to be discussing your investment documentation, there'll be a lot of focus around when can they transfer, how can they exit, because they need to do that in order to be distributing monies within a certain period to investors. Final thing to say, stating the obvious here, but VCs will almost always take a pretty active role in their portfolio companies, because they really want to be driving that exit. And the final comment is, you'll find that there are various different types of venture capital firms. Some will be a little bit more early stage, some will be sector focused. And what's going to be key for you is identifying which type of venture capital firm is actually going to be best for your business. Right, so that was a background. And now we want to look a little bit more at, sort of lift the hood on the different types of investment that there are out there. Kim, do you want to just run us through this slide?
Sure. Thanks, James. So the type of investment that you will most likely seek will depend on the stage at which your company is at. So as we've previously seen, very early stage companies will generally look to friends and family and high net worth individuals for financing, often referred to as angel investors. And as Takesha's kind of outlined, this will most likely involve a simple agreement between the company and those investors. As you kind of develop the company and develop your product, you will move on to most likely seed rounds, where the investors are slightly more sophisticated. They may look for more protection in terms of the documentation and the rights that attach to their shares, but largely there will be smaller amounts and they will be slightly more relaxed. Once you've got enough money and you've taken some investment from seed rounds to build up your product, it's most likely that you will want to attract some further investment. So Series A investments are when you have in your mind a firm idea of where your company is going. You've got a relatively advanced product, and you are ready to discuss with slightly more sophisticated investors. So at this stage, you should have a well-prepared business plan, and your company should be in relatively good shape. Just by way of example, when acting for Series A investors, they'll often look to make sure that there's a relatively good corporate governance structure in place. For example, there are employment agreements between the founders and the company, that you have in place all of your licenses relating to the product that you'll be marketing. So there's slightly more work to get to Series A financing, but it's worth it in the end. At Series A, you'd probably be looking for financing to get you a further 3 to 6 months down the line. You should always build in a bit of a buffer, because you never know when the next fundraising round will happen. So always make sure you're looking for a bit more than you actually need. After Series A or Series 1, in some countries, the terminology will depend on where you're located, but we largely see in the Middle East, the UK and Asia reference to letters rather than numbers. So the funding will happen sequentially. So you'll have Series A, you may have Series A, Series A1 and A2, which are largely on similar valuations, and investors will come in on largely similar terms. Series B may follow a Series A round, Series C a Series B round, and so on, until you get to an IPO, hopefully, if all goes well. So depending on the stage, as I said, depending on the stage at which your company is at, you should be looking to move to each round within 6 months or a year. And that is it for me. I think James is going to talk about the types of funding now. So handing over to you, James.
Thanks, Kim. Yeah, so this is a little bit of an overview about how the world of financing broadly breaks down. Now, it's going to be quite important for you as founders to be educating yourselves a little bit about what each of these are, in particular the boxes on the left-hand side of the page. Now, this is an overview. So on the left-hand side, it's largely debt or convertible type interests or investments, and on the right-hand side, it's more equity. So where you're actually holding an actual stake in the business. I'll just hand back to Kim to take us through each of these on an individual basis.
Thanks, James. So talking about convertible notes, these are more common in earlier stage investments we see. So seed rounds, sometimes in Series A, you'll see investors, it's often the investors that will request a convertible note. The main difference with convertibles and safes and equity are that these are debt instruments. The main feature, I suppose, is that debt will generally rank ahead of equity if there is a winding up or a liquidation of a company. So this would give investors slightly more protection than if they invest in straight equity. So the two key features in a convertible that the investors will be interested in are the valuation. So that is the valuation of the company at the time the investor is looking to make its investment. And this is separate from any valuation for future investment rounds. So an investor at convertible note stage will be looking at the valuation that on which its investment will be based. It will also typically be offered a discount. So that is to say, the price which it will pay for its shares, or sorry, will pay for the notes, which will be convertible into shares, should be will typically be less than the valuation that future investors will pay. So if we move to the next slide, to give you an example, if a company is looking to raise 20 million in a Series A round or a seed round, and it is proposing to issue 20 million shares, the Series A price per share will be $1 US. In a convertible note situation, if there is, for example, a 10 million valuation cap, and we divide that cap by 20 million shares, then the effective value of those shares is 50 cents a share, which, as you can see, is a relatively good discount to the $1 per share that the company will be looking to get from Series A investors. If we go on to the next point, the conversion discount, this is the discount which will be offered to the convertible note holders upon conversion. So where they hold notes, convertible, say they have 10,000 notes convertible into 10,000 shares upon a qualifying financing, and they have a 20% discount, they will convert their notes into shares at a value of 80 cents per share. So whilst that's a premium to the 50 cents a share, that is a 20% discount to what a Series A investor would be investing at. If we move on to the next slide, Oh, I think have we gone one too far, or is that okay? So essentially, the two points that investors and founders will be likely to focus on and will be the subject of most negotiation will be the valuation cap and the discount. And we largely see anything between 10 to 30% discount being offered to convertible note holders. So 20% we'd see as relatively market standard. But again, this is a point for negotiation and depend on the bargaining strength of the founders and the investors. So just to kind of recap, the benefits of a convertible note for a company are that it is a relatively quick agreement to negotiate. The founders are not giving away equity at the outset, and it means that you have investment coming in and you have funds coming in quicker than if you were to go through a Series A round. The disadvantages are that if there is a winding up or a liquidation, the investors, the convertible note holders, will rank ahead of any of your existing investors. So, for example, your friends and family who may have committed equity on day one. But we do see these commonly being used in seed rounds, and as I say, sometimes in initial Series A financing. So they are relatively common and they are accepted practice within the venture capital space. And moving on, I think Takesha's going to quickly run through what a simple agreement for future equity is.
Yeah. So as you can see, the term SAFE stands for Simple Agreement for Future Equity. And this instrument is essentially a promise to convert money into equity at a later date. And they are relatively simple agreements. However, the key distinguishing feature from the convertible note that Kim has just outlined is that it is not a debt instrument. So it is the way to get capital in at the early stages without the need to either upfront give away equity in the business or create a debt obligation over it, and thereby having the consequences that Kim's outlined on a liquidation. The typical trigger for the conversion of the SAFE, the investment into equity, is usually a priced equity round. And being having the characteristics of not being a debt instrument, using a SAFE note will mean that the terms do not contain either a maturity, as with a loan, or any interest. So the SAFE note will not bear interest and will usually continue until either a priced round or a trigger event, such as an IPO or an acquisition, etc., which would cause the note typically to terminate. One of the key benefits of the SAFE note is it's a relatively standard form agreement. So it was created by the Y Combinator in 2013, and the terms have been updated sort of periodically. And so as a result, there are 4 standard forms that can be used. So therefore, not much legal cost, relatively quickly to get the investment in place, and just very broadly, very quickly, the 4 sort of key types of the terms that you'll see when you're using a SAFE note are the standard SAFE note, which provides for a valuation cap but no discount. Alternatively, one that provides for a discount but no valuation cap. One that provides for both a valuation cap and a discount, and then one that has no discount, no valuation, but a most favoured nation clause, which would apply in the event of a dispute. One of the key things to look out for when you're using these instruments, SAFE notes, as I mentioned, is typically at the outset of the growth of the business. And it can be difficult sometimes to keep a handle on actually how much equity you are giving away, because you're not initially giving away equity when you're putting in when you're getting these arrangements in place. So it's just something that needs to be monitored quite carefully, so that you can keep a very close eye when you then come to do a priced round, how much you've agreed to give away. Kim is now going to talk to the mechanics of a priced equity round.
Sorry, just before we move on to the onto the price side, if you read anything, do go onto the Y Combinator website. They've got some really great materials there explaining exactly how their documentation works, because 9 times out of 10 you will be looking to agree one of these documents with your investors, and the only bits that you really have to negotiate are going to be, the valuation cap or the valuation cap and the discount in these documents. But it's still important for you to understand, even though it's effectively a non-negotiable document, how they actually operate, so you don't have any surprises down the line. Sorry, Kim.
Thanks, James. So once you have been through your seed round and your pre-seed round, hopefully you will be at a stage where you're ready to look for Series A and go out to the market and raise further funds. So this is what we often refer to as an equity round, where you will be issuing equity in your company on day one, which means you will need to have a valuation carried out on which you will price the round. So you would have a formal valuation done on the company, and you would base your price per share on that valuation against the number of shares you're proposing to issue. So a Series A round is often more involved and more complicated than earlier stage financings. You typically, hopefully, look to get lawyers involved at this stage if you haven't already, particularly as Series A investors will have their own counsel and will be looking to do due diligence and other more formal investigations on the company to make sure that the price is right, that you've got your ducks in order. The equity round will usually involve the issuance of preference shares. So that is shares that have a preference over and above existing common stock of the company, and these will usually involve things such as liquidation preference, so that if there is a winding up of the company or there's an exit, the holders of those preference shares will have priority when the assets are distributed, and this can be either 1 times the initial purchase price, so they essentially just get back what they put in ahead of the other investors, or it may be 1.2 times, so they will get what they put in, but there may also be a coupon attached to that. They may also have preferential dividend rights, so that you guarantee a minimum annual return of an agreed percentage ahead of the ordinary shareholders. They may have veto rights. It's quite often the case that Series A investors will require the company to agree not to carry out certain things without their consent. So, for example, issuing new shares which would dilute them, or issuing new shares at a discount. So things like that, over which they will want to have a say before the company can go ahead with any of those. Series A investors would also typically want anti-dilution rights. So they would want the right to subscribe for shares in future issuances and thereby maintain their percentage. It's quite beneficial for companies to issue preferred shares, as it allows the company to issue different classes of shares to prospective employees as at a significantly reduced price. And this can incentivize employees as well to contribute to the business where the company may not have the cash to start with. So they may not have a lot of cash to offer to employees. So this is a great way of incentivizing them, but without eating into the company's cash reserves. Another feature of these shares is that they are more often than not, convertible. So they will be convertible into ordinary shares in the company at a particular point in time. So usually this is pegged to an IPO or the next qualifying financing round. And often investors will try and keep their options open. So they will often want the ability to convert at their option, or where there is, for example, an IPO coming up. Now, again, this is a point for negotiation and will depend on the bargaining power of the parties. So if you are, if you're in a strong position, then we would advise that that the conversions only happen at the point in time when you're ready to IPO, so that you're not giving away ordinary shares before you absolutely have to. Other features of these shares, as set out here, will be that they will be subject to preemption rights and rights of first refusal. At this stage, you'll typically also be expected to enter into a shareholders agreement with investors, and the shareholders agreement will set out the various rights attaching to these shares. This will again be often can be a lengthy negotiated document. So we'd advise getting outside counsel at this stage.
Yeah, and just a quick observation on that front. We were talking about a significant amount of standardization around the convertible notes and the safe documentation. And in many respects, that should be able to be carried across into the shareholders agreement setting out the terms of the convertible preferred shares. And there are certainly some standard approaches that you see out of the market. So those that are maybe coming from a more North American ecosystem, there's the North American Venture Capital Association standard suite of documentation, and likewise in the UK there's the BVCA, the British Venture Capital Association standard suite. There, they take us. Essentially, the contents are probably the same, but they've documented in very, very different ways. So that is always going to be a good starting point on this. But when you get to Series A, the gloves sort of come off a little bit. Investors are looking to get best terms, and we see increasingly quite a lot of non-standard or more bespoke language coming through to the documentation. So just to echo Kim's point, this is where you really do want to be getting external counsel on board to make sure that you are getting appropriate terms. In particular, as whatever you agree in your Series A is more likely than not going to be agreed or form the basis for your Series B as well. So you've sort of got a one-shot chance at getting it right. You're never, when you go through your funding rounds, going to be suddenly able to get a fundamentally better deal than the one before.
It's also worth bearing in mind, I think, that these investors coming in at Series A will have done these, hundreds of these deals. So they know exactly what they'll be negotiating. They know probably how far they'll be able to push you. So it does really help if you have, you have legal counsel on board ready to defend.
There's quite a lot of legal terminology on this slide, and Kim's gone through it at a high level. Is there anything that you would like us to pull out again, or is this all for the time being relatively clear?
If anyone has a question, just drop it into the Q&A function.
Okay, then maybe just some concluding thoughts here. I think a lot of these on this page just make sense. There's no sort of magic to many of these. But just to quickly run through them, do look carefully at who you want to have on your cap table. It's not always about just getting the cash in the door. Yes, it is important, but actually you want that money to be clever money that's really going to be supporting your business on making the next step. So ensure that your investors aren't just providing capital, but they can provide a level of sort of wider support as well. Do look to create a certain amount of competition, in particular if you're in one of those or working one of those very, very hot sub-verticals in the fintech sector. That will always give you options, but don't overplay your cards on this. Don't overplay or play parties too obviously off against each other, because it's a very, very small market, and the VC houses all do speak to each other. A little bit maybe counter to the couple of points I've just raised, do focus on the investors that you can actually close. Yeah, there may be those absolutely fantastic investors that are going to be really creating a very significant additional benefit for your business. But if you can't close them in time, well, then that doesn't make, that's not going to help. So do focus on the money and when you can get it. And when you've actually made that decision, close. A lot of the time we actually feel, or we see sometimes founders second guessing themselves on their terms. And yes, you might be able to get a little bit of incremental benefit, but actually there's a law of diminishing returns sometimes on these things.
James, I think now would be a good chance, sorry to interrupt you. We've just got a question on, can we just elaborate a little bit on what investors typically look for in the founders when evaluating a particular project? So I think we touched earlier on having sort of formal arrangements in place. So depending on who the investor is and what the nature of the business is, the due diligence process will vary, and there can be sometimes very focused due diligence on the arrangements with the founders, whether or not they're going to be locked into the business, and if so, the period for which the founders will be locked in. Similarly, there will also be focus on, you know, whether the founders are, whether it will just be certain of those founders or management that will be locked in or subject to any types of arrangements there, or whether there are key specific people that are needed in the business in order for it to grow. Kim, James, I don't know if there's anything else that we can add to that.
Just from my side and related to the founders, investors are also very focused on IP, especially in this industry where a lot of the value of the business is in the IP. So they'll typically want to make sure that any IP that's created vests in the company and not with the founders, so that if a founder does leave, then the company still has the value of the IP. So a lot of focus in due diligence will be on the kind of intellectual property arrangements and the employment contracts to make sure that they adequately protect the company and the investors' investment.
Yeah, all very good points. And so there'll be a lot of legal protection that'll be focused for the benefit of investors around ensuring that that the founders are incentivized to stay in, and also that if they are no longer there, that the business still has the ability to function. Moving away from the more sort of legal aspects, founders are critical to the success of the business, because it's not just the idea, it's actually the drive and the ambition about creating something big and exciting. And the VC houses, they really want to tap into that. They don't want to run the business from day one. Might be a little bit different with the strategics, but with the VC houses, they're making a pure sort of financial investment. It's all about who you are as individuals. And so when they're doing the due diligence, so much of the time, it's going to be a focus on you as individuals, your strengths from a personal perspective, your weaknesses from a personal perspective. Do you have what it takes to move a business from startup to something which is potentially going to be listed? Good question, very good question. Just on point 4, it sounds a bit stupid, but always feel free to ask why. Quite a lot of what we've been talking about today is actually quite complex. You know, we deal with this on a day in, day out basis, so we understand it. There's a lot of jargon, but we are able to go toe to toe with the professional investors. This is not your turf. Your turf is building the business. The mechanics of your operations, your customer relationships. It is almost, no question is almost too stupid to be asked. So do feel free to ask them. And sort of a related point to that is, don't try to negotiate in real time. There's no need to, even if people pressure you to be doing deals quickly. There will always be the ability to put the phone down, have a think about it, engage with your co-founders or mentors or advisors to work out what is actually right in your circumstances. There's a lot of stuff you can negotiate here. Pick your battles. Again, some of these battles will maybe give you a slight incremental benefit, but in the grander scheme of things, it's not necessarily going to be that big.
Yeah, and just on that, we have another question about what is the most important negotiating point for convertible preferred shares.
I can take that one to start.
Good question.
Yeah,
like
good
question
question.
today.
I was going to say, yeah.
So there are.
Choose your favourite, Kim.
Well, where do I start? I suppose it's split into different categories. So there is the financial, I suppose, is one. So what are you looking to get out of the investment? Are you looking for, just 1 times rate of return, 1.1, 1.2? So that can often be quite heavily negotiated. What we find is that the reserved matters, which are those matters over which the investors want a veto right, those are often quite heavily negotiated because the founders want to be able to run their business without having to go back to investors for their approval, for every minor point. But at the same time, investors need certainty and they need to know that they're protected and that the company can't just go off and, for example, sign up to a facility agreement for millions of dollars without their input, without their say-so. They can't enter into joint venture arrangements with, third parties who investors don't know or who might be competitors without the investor say-so. So I'd say actually it's the reserve matters list that you often find yourself negotiating at length. But I suppose the main point there is, investors aren't looking to hamstring companies. They're looking to protect their interests. And similarly, founders should be looking to be able to just continue to be able to run their business. So it shouldn't be too contentious, and you should be able to find kind of a balance which gets both parties to where they need to be.
Yeah, I agree with that. It's about getting the right balance in the circumstances. Sometimes we do see, and this is often with more or less sophisticated investors, that they throw sort of the kitchen sink in, and actually when you then have the conversation with the investors, they don't really need it, and actually they recognize that there are real benefits to founders having flexibility to be nimble and agile in how they run the day-to-day business. And a linked point is going to be who sits on your board as well, and you just need to be a little bit careful about that, because if you are put in a position where you're going to be in a minority on the board, you've automatically lost control. So that day-to-day business I've just been talking about will actually no longer sit in your hands as founders, but actually in your investors. Good questions. Takesha, are there any more coming through?
Nope, that's everything.
We've sort of reached time on this. If there are no more questions, then I'll wrap up on our side. Thanks very much again to the DIFC FinTech Hive for enabling us to host this presentation. It's been really, really good talking to you and answering your questions. We appreciate that a lot of this is going to be new. You've got our contact details in the slide. If you just want to shoot the breeze on any of these things, even if it's something simple relating to the safe notes, do pick it up. We're there to support you as legal sponsors to the Hive. It'll be a pleasure to continue the conversation outside of this presentation. Thank you very much, everyone.
Thanks, everybody.
Thank you, Simmons and Simmons team. Have a good day.
Bye-bye. Bye.